Hey everyone, how's it going? It is May 2nd, Thursday, half an hour before the market opens. Yesterday, we had the FOMC rate decision and the press conference, which gave us a lot of volatility. So we were already in a rising volatility environment. Then we got the FOMC, who have a whole bunch of earnings. So that increases volatility even more. That means prices are going to move up and down quite a bit. I'll talk a little bit more about that later when we look at specific positions or specific stocks. But yesterday, after the FOMC minutes, we started to get volatility in the markets, and then Powell started speaking, and we started to go way up. And then at the end of the session, we completely undid everything that Powell said. So there's a whole bunch of volatility in the market right now, and we're going to just expect larger movements in the market than we normally see. So when we go and look at the futures this morning, we're going to take that into account in our evaluation of what is random and what is non-random. So in the futures, we've got the S&P up quite a bit, about 80 basis points. We've got the Dow up about 2/3, about 60 basis points. And then if we got the NASDAQ at about almost 1%, right? Almost 1%. So I'd call that about 90, 95 basis points. So we're up a lot. So I would call that beyond random, even taking into account the normal volatility, which means that there is definitely upward movement. That's really interesting given the price action that we had yesterday. So if we come over here, yeah, you can see we went way up during the FOMC. I'll get to normal 1 minute chart. Well, I guess 5 minutes is good for now. We can see more on the screen. So we went way up, and then we came all the way back down below the open right here by the end of the day. And we started to creep up after markets and into the European session, and looks like in the Asian session and in the pre-markets, we just kept on moving higher. It looks actually there's a gap up and the very small slight upward movement. That's interesting right there, that gap up between the pre-market and the post-market. I'm sorry, the post-market and the pre-market. What does that mean? Well, we are in the pre-market, we came up back to that 505 level that was critical, and we're backing off a little bit as we get closer to the American Open. So what it means is not a lot of conviction, or I should say that there is a balance of forces in the markets. There's a pocket of traders that are really bullish, and then there's a pocket of traders that are really bearish. So what we're going to see probably starting today is this interplay between the bulls and the bears. We're going to have a little bit of a, I don't want to call it a fight, but a competition to see who's going to win out. And the points where it's going to be very important are these levels that we have drawn right here. So every time we reach one of these levels, especially the thicker line ones, there's going to be a struggle between the bulls and the bears, and it's going to be important to see which one comes on top at each particular level. So the first one we're probably going to test, at least given that we're up so much in the futures and in the pre-market, we're likely to test this 505 first. That's going to give us our first clue this morning. So we want to watch that very carefully. I wouldn't be making any decisions in terms of day trading until I saw the prices definitively break above or get rejected from 505. I would suspect that we hit that level and then either trade sideways right on the level, or we hit it a couple of times before we get a true direction. So if we break through and then come back and retest, Don't get too excited. Just wait for it to move, or if it hits it and has trouble going above, don't get too excited until you actually see a conviction move right here. So when we move way up like this and completely undo it, and then in the aftermarket sessions or overnight, we should say that we retrace more than half of it. That's like, it's not uncertainty, but it is uncertain which direction is going to win out. It shows a lot of momentum in both directions. And when that happens, then what we were talking about over the past few days was the possibility of us bouncing in between the MA90 and MA50. That becomes a higher probability. Yesterday at the close, we felt that that probability wasn't too high given how strongly we retraced back after that huge movement in the FOMC. Well, this morning, look where we're going to open. It's right at that EMA 8. You see where this orange dotted line is? It's probably really hard for you guys to see, but it's right below that EMA right here. And so the EMA 8 is at 504.1. We just talked about how the 505 level is going to be really important. Well, this 504 is pretty important as well psychologically. So that 504 to 505 region is going to be really important to watch to see what we do right here. If we can stay below or right at 505, not go significantly above it all day, then that reaffirms our previous conclusion that we had a higher probability of moving back down to the MA90, challenging it, and probably breaking through it. If we stay up here in between the EMA 8 and the EMA 20, however, or if we get a little bit beyond the EMA 20, then the probability of us bouncing back and forth goes higher. And I wouldn't completely discount it. And now that we see the momentum moving back up, suddenly that probability increases. And given the overall strength that we've seen in these markets in the past year, then hey, it's not impossible. That suddenly this probability has gone significantly higher than when we looked at the market in the post-market session yesterday. So now we have to deal with this possibility. If that happens, what it means is we're choppy for a little bit. Stock picking is going to become really important. When we chop sideways, it's very difficult for us to, in a single stock or a single position or a single option portfolio, it's going to be difficult for us to be able to make money because now you can't go with trends anymore. You can't just hang on to an option and watch it go down and go down and go down and go down and go down, or go up and up and up and up because you have all this chop. So you have to go shorter term, which would make sense in a high volatility environment anyways. But if you chop in a range, a lot of times you lose that volatility also. So it's basically the toughest and most difficult environment for a single options portfolio. So we'll have to start picking things we always pick things very carefully, but it becomes even more important and even more difficult when we start hitting these choppy regions, especially if these bars start to get smaller. When we have large bars, then okay, you can still find those opportunities. So visually, what I'm talking about is, for example, ACN. It's down, it's down, it's down, and went sideways a little bit. It's down, it's down, it's down, it's down. This is very clearly trending. So if I enter a position, say over here, even if it's the sideways period, then at some point in the near future, I can count on it moving quite a bit and I can still make money. That more than makes up for this time decay that I experienced during this time period. But what if it just keeps going sideways? And I just get killed by time value. So what that means is what we want to do is start taking a shorter time frame approach, or what we want to do is if the position doesn't move in our favor within 2 or 3 sessions, it's gone. You just uh, indiscriminately just cut it and take whatever loss you have in terms of the time value, and then the price movement won't be huge. So we also have to choose our options very carefully, because we don't want a normal day's movement to represent a 30, 40, 50% change in the option. That might sound like a great idea because, hey, in a normal day, if it just moves a normal amount, I can make 50, 60% on my option. Well, if it also moves a normal amount in the opposite direction that you're counting on, then you lose 50, 60%, and you don't have a trend to rescue you. When you can't say, okay, well, it doesn't matter because I'm going to chop back and forth 50 plus 50 minus 50 plus 30 minus 30 until I resume my trend, and then I can make up for all those losses. So we can't count on that in a choppy environment. So we have to be very careful. So an example in one of our portfolios is Charter. And you can see that after earnings, it just chopped sideways for a couple of days. So this is a normal movement upwards. If we get a normal movement downwards, and then a normal movement upwards, and a normal movement downwards, we're just eating time decay, and it'll just keep going sideways. What we need is a resumption of a trend. This trend, okay, that got resumed a couple days before earnings, and then it popped back up, and then it hit resistance. What we need is to start trending very quickly in the next day or two. Otherwise, it's going to be stagnant if the market is stagnant, and then you just want to cut that position really quickly. So we need to start looking at a shorter time frame in terms of getting results. We want almost immediate results, and we're going to be less patient about keeping a position on, waiting for that trend to resume. So let's take a look at where the rest of the indices, actually what is really important right now is volatility. The current environment is volatility. When volatility changes, that's really when you want to shift strategies in a portfolio. Because if I have a portfolio, or if I have a position and volatility changes, my risk changes. The risk from, okay, let's say let's say I put on a position today, right here. And let's just say for the next 5 months, prices are the same. The reason why I'm doing that, I'm going to fix prices so they don't figure into my analysis. The only thing that changes is volatility. So if I know for sure that prices are going to be the exact same over the next few days or few weeks, what does volatility do to my portfolio, my existing position? So it goes way, if my volatility increases, if my prices, daily fluctuation of prices goes from whatever this is, just say 5 on a daily basis, and I go back and forth 5, and then suddenly it starts going back and forth 10, then my risk in that position just doubled. My position didn't change, but my risk doubled. Why? Because my P&L is swinging twice as much up and down. So I didn't do anything. I didn't make any changes, but suddenly the risk that I'm holding onto has doubled. And that's a scary position for a money manager or a risk manager. And that means just from a risk perspective, I should be taking action. I should be taking action to change my portfolio. If I'm holding on to a lot of positions, if I have 10 positions, if I actually have a portfolio instead of having one position or two positions on at the same time, then what I need to do is actively manage my risk, which means either hedging or reducing my position. But then when it swings back up, then I need to add to my position. Every day I'm selling and adding to my existing position, which is called rebalancing, which is what portfolio managers of hundreds of millions of dollars and billions of dollars, that's what they do every day. But as an individual without that many positions and without that much capital at risk, we just kind of ignore that. We just say, okay, well, I accept that my portfolio is going to be twice as risky. So, but in reality, we should be managing that risk as well. So what that means is, okay, well, maybe I don't manage the risk on an existing position, but when I go and I put on my next position, I'm going to take into account that the risk that I'm holding on to has changed since I put on my original position. So we have to take that into account. We have to be aware of it, of the risk environment that we're going into and how it's changed since we put on a existing position. So basically what that means is if I put on a position, like just say on Charter, I put on a position expecting, yeah, we might be going into a higher volatility environment, or actually I was expecting the volatility environment to stay the same and that I could count on a trend and that I would hang on to it a little bit longer. And so I picked a longer expiration option, or yeah, and I picked my strike so that I had the appropriate delta for that type of strategy. But suddenly my volatility in the market changes, and I go, oh, I really should have a shorter time frame, a shorter expiration, a different delta. Well, I don't have the freedom to change that because let's just say I only have one contract. Then I can't cut my contract in half. So the only way I can balance that out is with a new position that goes way short, so that on a portfolio basis they balance each other out and I'm positioned the way that I'm supposed to be in the given volatility environment. So that's why I'm very interested in VIX and I'm very interested in ATR. Now in Charter, ATR is still low, right? But if we're expecting it to creep up, then I've got to be aware of that. I need to start shortening my time horizon. So VIX is going to tell us a lot. VIX is down today versus yesterday, down quite a bit. Yeah, I mean, it brings us to the bottom of this area that we've been what we would call normal since April. So that is implying that the upward potential for today is slightly elevated. Of course, that could change any moment. VIX changes very quickly throughout the day. It's just where we are right now in this moment in time. Volatility is, if we're at this baseline volatility right here, it doesn't necessarily mean that we're going to stay at this baseline volatility. So what I need to be aware of is if that S&P 500 does decide to move down from that current 505 level down to 500 and break 500, I'm going to see volatility spike again. And then we're going to have to become much shorter in terms of our time frame. So yesterday we were watching VIX very carefully. Today is another day that we're going to watch VIX very carefully, maybe for the next week or so until we actually get a definitive break downwards or we move upwards. The other thing that's going to be important to watch is earnings. So today before market, ConocoPhillips, we had some utilities and energies, some healthcare. right here. I'm not going to look at those specifically because the S&P 500 is already telling us that even if they happened to do very poorly, there's other forces that are bringing this market upwards. And so it doesn't really matter if they did well or if they did poorly. The market has already shown us that is very directional to the upside. Either it's supported by earnings or it's not. That particular piece doesn't really matter. What might change it is upcoming earnings. The earnings that already happened don't really affect us anymore. And unless if they're a huge market cap company, then they might affect us for 2 or 3 days. But other than that, we don't really care. They won't be a force in the market. So if I look, but the ones that are coming up imminently, those are a force in the market. So today, after market, that's what we're really interested in. And we've got giant right here, Apple, 6 trillion market cap. That's definitely potential to move markets. So we've got Apple, Amgen is quite large, but really it's going to be Apple. And a lot of people and a lot of institutions hold and follow Apple. So that's going to be a very important one to watch, the APL. And even before earnings, they're showing a lot of volatility. Look at that movement, $2.50 on 169 in a pre-market action, 1.5% pre-market. 1.5% is what we kind of expect on the extreme end on the S&P 500. And the Apple, which is a huge stock, it has huge market cap and it has huge weight on what happens in the S&P 500, is already up 1.5% pre-market, which is probably a major reason why the S&P is up so much pre-market as well. But they're up right into resistance, MA50. So what's happened over here, we came up here, MA20 came back down, MA50 came back down, MA50 came back down. And then we're opening back up at the MA50, and then we have earnings immediately after. So those earnings most likely are going to either send us into the MA200 or send us way down to lows right here. That would be my normal expectation. And if we have an extreme, then we pop above the MA200 or below the low right here. So what that means is that Apple is going to heavily determine which way the market goes tomorrow. And maybe on Monday, we have a weekend in between. So the subsequent market session influence of Apple is diminished because of that weekend. But for sure, this is going to have as long as it moves. If it doesn't move, it's going to have zero impact on the market. But if it moves, it's going to have a huge impact on the market. So we have a lot of heightened risk in the market right now. Volatility, risk as measured by volatility, which means what we do nothing and an existing position can just swing really wildly for or against us. So we don't want to add positions into that type of environment. We may want to reduce positions into that type of environment, and we may or we may just hedge into that type of environment. It just depends on how well we positioned ourselves before. So if we took a full allocation of risk before, then we probably want to hedge or diminish our positions. If we kind of knew that volatility was up and that we had all these risks in the market, and I only took a half position or quarter position of risk to begin with, then maybe you do nothing because you already sort of took that into account. So it just depends on where you are. Just be aware that in the next 24 hours, or I guess I should say maybe add another 10 hours. So 32 to 34 hours. So into the the next two trading sessions, in the next two trading sessions, we could see a huge amount of swings that seem abnormal, but they're actually normal given the volatility. And we might feel it more because we see our P&L swing back and forth more than we're used to seeing, but is actually normal. So that, I guess that is the main idea of talking about all of this volatility. So if I have a position and I go, oh my God, in a single day, it went down 50%. I'm not going to freak out as long as the underlying price movement was still normal for this given environment. So for example, on Charter, if we went up just to the EMA 8 and you see this bar is tiny little bar, it's the same as this bar, 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 that's a normal movement. But let's just say on my position, that represented a swing of 60% against me. And I go, oh my God, I'm down 60%, close my position. No, then you're trading your P&L. You're not trading your position. You're not trading the stock. You're not trading the underlying movement. You're trading your P&L. You go, oh, that was a normal movement. It hurt more than usual because of the heightened volatility environment. And go, okay, well, if it just swings like this, again, except in my favor, and it just moves the exact same amount back down because it looks like we might be in a tiny bit of chop right here, then I'm back to break even or slightly below break even. Okay, I just have to accept that the swing is going to be higher right now. And if I can't accept that, then I hedge it or I close it. That would be really so you go, oh well, we ended up at the same place, Kane. You ended up closing the position, but I closed it for the right reason because the risk became too much for my appetite or for my portfolio mandate, not because, oh my God, I lost 60% in this one position. It's a different psychology and different mindset. One will preserve your capital and one will lose your capital. So if you keep on doing it repeatedly. So I'm not thinking about this one incident. I'm thinking about repeated incidences over time. And so one will preserve your capital and one will lose your capital. And you want to be the guy who preserves capital, not the guy who loses capital. So I spent a lot of time talking about that, way more than I expected. And we're only 2 minutes before market open. We'll just expect volatile sessions today. We're going to watch that 505 very, very carefully and see which direction we break, either up or down. So I'll leave you to watch the open in less than 2 minutes, and I will see you in the post market.